Anyone not familiar with the workings of the wine trade may be forgiven for thinking the most important overriding issues rest in the quality of the grapes, the harvest and the vintage of the wine. In reality, often all lies more in the strength and weakness of that country's currency, whether or not its wine is going to be bought or not. Our next speaker lives, breathes and trades in the currency markets. Smart Currency Exchange offers bespoke trading advice to businesses of all sectors where currency has an immediate impact on their bottom line. So this is up for the next 20 minutes or so could help make or save you thousands of pounds. So from Smart Currency Exchange, can I introduce Nick Ryder.
Thank you very much, Richard. So as Richard said, we basically specialise in foreign exchange, and we work quite closely with a number of companies in the wine industry. So what I'm going to do is just go through simply how we've helped a number of companies, a few mistakes companies in the wine industry have made as well, and what we can help do about it. So first of all, why am I here? The wine industry has really suffered a very incredibly tough few years with unprecedented volatility in the foreign exchange markets. Now, since 2007, the pound has dropped by over 30% against the US dollar, at 0.45% against the euro, and over 30% against the Australian dollar. So it's easy to see why Harper's and its readership are fully aware of the impact currency has on the wine industry. Now, Harper's approached us following recommendations from several readers with the aim of giving their readership access to specialist opinion and advice on foreign exchange markets. So we now have articles, case studies, opinion pieces and exchange rate updates published in the magazine, and also our daily market commentary is published on the Harper's website. So given the theme is really about cutting costs, our business is about doing just that. And we save companies money on their international payments. So let's just look at what we're going to talk about quickly. First of all, we're going to run through some examples of some companies that have come to us following poor currency management, and drawing on some examples from the wine industry. Next, we'll look at how we actually remove that risk from international payments. Then we'll look at a way that currency risk management benefits maybe the smaller sort of wine merchants when tendering for large contracts. And then Richard's asked for a bit of crystal ball gazing as to what's happening over the next few months with sterling and where things are likely to go. So first of all, just to give you a bit of background on this company, this is an example of wine imports that came to us after they lost a significant amount of money due to currency fluctuations. So they're UK based and they were importing from Europe in 2008. So after particularly high demand for this particular wine the year before, they decided to put in an order to import wine over the course of the next 10 months in two main batches totaling 1.5 million euros. So you see this at the bottom, this is end of 2008. So they were budgeting 1.5 million at 125, equating to roughly 1.2 million pounds. The first batch was to be delivered in 60 days' time, and payment was due at that date, and then the second payment was due 10 months later. Over the course of 60 days, the euro rate had weakened from 125 down to 119.88. Which meant that the first payment, which had originally been budgeted for at £480,000, actually cost them £500,500. And then still no action was taken in terms of protecting themselves against the risk. And the final payment came through. It was £900,000, and it weakened even further down to 110.10 towards the middle of 2009, sort of July 2009. So the final payment obviously cost a lot more, and 817,438, and overall that left them with a total loss of £117,938 on what had initially been budgeted for. Luckily, this particular company managed to absorb the loss and actually survive, but it led to significant issues for that year. And since then they've been in touch with us, and we're actually helping them protect themselves a lot more. Now the second example is the other way around, moving euros into sterling. And this is a company that, alongside their UK business, exported their wine consultancy services over to Europe, which obviously paid in euros. Now, Given the weak pound around Christmas 2009, they secured a lot of overseas business as a strong euro made their services very attractive to overseas clients. So yeah, Christmas 2009, bottom left there. So they knew that they were going to be receiving over the next year 6 payments of around 150,000 euros from all the clients combined. At the time, 110, given the euro's particular strength against the pound, they thought that was an effective, fairly fair budgeted level. And so up until March, the negotiations were going on, the euro sort of weakened a bit and it came back down to 110. And then, so overall they're expecting to receive around £136,363. First payment came through at the beginning of June, 150,000 euros. Sterling had strengthened as the European debt crisis was in full swing, and it came to £126,050. So essentially they lost £10,313 of what they'd been expecting. And then similarly a bit later on, sterling strengthened even further, and it was exchanged at 122, equaling sort of £13,000 loss. Now, at that point they decided to get in touch with us because they didn't really know what to do in terms of actually, did they gamble a bit more, did they desperately try and see what was happening. And since then we've actually managed to protect them from losing any further money down to the currency exchange market movements. Unfortunately there's going to be a loss on where they were originally budgeting at, but we've actually managed to secure those levels in for them and protect them a lot further. So let's move on to how you can actually protect yourself and remove that risk when buying or selling in different currencies. There's actually one principle that's very easily forgotten, and that is when undertaking a contract, you need to ensure that it's going to be profitable at completion. Now this may sound like a fairly elementary business principle, of course, and it's also very easy to put into practice when you're dealing in the same currency. But in our experience, many people actually forget that the price of overseas goods fluctuates virtually by the second, as the rates are changing every second, every 5 seconds, and nothing is actually secured until you fix the rate in. So having seen the extreme cost of those adverse market movements in those examples above, let's have a look at actually how you can mitigate against that risk. So there's 2 main options. First of all, it's called a spot contract. It's the very basic form of currency exchange, very much like if you're at the Bureau de Change buying your holiday currency. You buy now and you pay now. Now, as we're specialists, we work from live market rates. The prices we offer are significantly better than the bank. So let's give you a quick example. Here's a payment via a spot contract one of our clients did on Friday. They were importing some sort of vodka miniature packaging, pre-packaged vodka miniatures in time for Christmas. They were being manufactured in China. They need to send $126,000 over there. The bank offered them $152.30 on that, which is a sterling cost of $82,731. And the rate they got through us was $153.41. Doesn't look like a big difference, but it's actually a saving of £598. If you add that over the course of a year, it's a very straightforward and easy savings to be made. Now, this has the advantage that you're physically buying the full amount of currency at a better price, and it can be transferred immediately, ensures you're removing all the risk of the exchange rate moving against you. But the major disadvantage of a spot contract, especially over a long period of time, such as the examples we looked at previously, is that you need to tie up, in the first example, nearly £1.2 million over 10 months to completely remove all the risk in the contracts. And unless you're an extremely cash-rich business, this is totally unfeasible and inappropriate. So this is where what's called forward contracts come in. This is where you essentially buy now and pay later, meaning what you can do is actually fix the price of the goods that you're planning to take hold of at a later date. It's an agreement to take delivery of a specified amount of currency over a period of time at a rate that's been agreed. So you can use all of the funds or part of the funds up until the expiry date when the funds have to be taken. And the major advantage of this is that you lock in the budgeted profit at the beginning of the contract and ensuring you're not going to lose money. And cash flow is retained as you send through sterling as and when the payments become due at that pre-agreed rate. This also means you have a peace of mind and you can essentially not worry about what's going to happen in the Eurozone or the USA and the economy, and just have that peace of mind and that risk is removed. There is one downside, however, And that's if you get to the point where you need to pay and the exchange rate on that day is slightly better, then you don't benefit from that higher rate. But the majority of our clients actually prefer not to gamble and actually prefer to lock in that budgeted profit right at the beginning and then say, well, at least I'm making money here. If it moves up, but it is essentially gambling in that regard, and you can remove that risk of losing money.